So, good evening, everyone. Welcome to Ortho TV. On the occasion of Bone and Joint Day, we decided to take my financial advisor's advice and let's talk on financial well-being, as I feel that they are the only firm specializing in the doctor segment in entire India. So with this, I hand over to Meena Sriram, who is the head of the doctor practice at MFA, as it is popularly known as. Over to you, Meena.
Thank you so much, Neeraj. I just wanted to know, should I wait for 3-4 minutes for people to join in, or is it a good?
We should start.
We should start?
Yeah, we are already online.
Fine, perfect. Like as you said, questions will be pouring out. Yeah. Yeah, so better to start early. Okay. So once again, thank you so much, Dr. Neeraj. I am really excited. And like me, there are a lot of people who are looking forward to this session. And actually, this session wouldn't have happened without the support of Dr. Ram, you, and Dr. Shiv Shankar. And a big thank you to everyone and our esteemed panelists for taking out time today. And I will share my screen so that you can see what is today's topic. It's going to be a very interesting one. Can you see this? Can you see my screen?
Yes.
Yeah, I'll just put it on slideshow. Yeah. So today's topic is on personal finance, doing it the right way. I think the right way is very important because I keep getting a lot of questions on, okay, how do we decipher who's the right advisor for us or coach for us? Yeah. And our today's speaker is our dear founder, Amar Pandit. Hi, Amar. Hi. Amar has actually logged in from US. He's gone to US to take care of his elder daughters, university formalities and everything. So we all are excited, me, Amar, and the entire team. And I can see my clients, my doctor friends, and my colleagues who have joined in today. So before I start with the session, I thought I'll give a quick brief about us, which I'll try to make it as short as possible. So MFA is the only company in India having a dedicated practice for doctors. Just like doctors, how you are specialist, we also specialist when it comes to managing doctors' money. And in the last so many years, we have interacted more than 10,000 doctor families. We actually know your pain point, your challenges, your entire life cycle. We know what ticks you, what makes you happy. Yeah. And honestly, this journey, when Amar started in 2005, we didn't have this dedicated practice. But when this book was published, and this book was published where CNBC approached Amar to write this book. And when this book was published, I actually went about meeting doctors, and doctors who read the book, they told me, Meena, this is my life story. Exactly. And some doctors were depressing. Arey, ye to, whatever mistakes Amar have said, many sub mistakes commit kiya hai. So that's where our journey with doctors started. And I would say this fraternity has purely grown through references. And I'm seriously blessed, my entire company is blessed for having one of the finest and the topmost surgeons in the country as our clients. Yeah. So moving on, our associations. So in the last, I would say in the last 16 years, we as a firm, we're extremely passionate about financial literacy. And we have been conducting these financial literacy sessions and awareness with the various associations. And we also the financial literacy partners with the Indian Orthopedic Association. Moving on, MFA's practices. Okay, so doctors typically ask me, do you only specialize in doctors? I said, no, we specialize in other segments also. We are the corporate executives, business owner segment, celebrities. And in the last 3 years, we have been focusing on the retiree segment because that's a segment that really needs help. And then a lot of independent women, we have been helping them out. And in the last 3 years, every quarter, we conduct our financial literacy session for women. And then we help the special need families with their planning. And this particular practice is something very close to our heart. So these are the various practices, or you can say these are the various specializations where MFA specializes in. Moving on, the role that we play in our client's life. This is a very beautiful picture that depicts the role that we play in our client's life. So you can see the Sherpa, And this mountain climber, he wants to reach out to the goal. His goal is to reach at the top of the mountain. Now, can he really do this without Sherpa? It's difficult because it's the Sherpa who's experienced, who's trained, who understands the terrain, and he understands what kind of weather changes can happen, and when he should start the journey, when he should stop this journey, when the landslides can be expected. So it is actually difficult for any mountain climber to reach the goal, mountaintop goal, without Sherpa. So similar role we play in our client's life. So the role that we play in our client's life is that of a trusted financial coach. Yeah. And we actually don't let anything come between you and your goals, not even you. When I say not even you, what I mean is your personal biases, your emotions. Because see, when you're investing, you are a lot of, and these decisions, usually these decisions come from an emotional side. And it is very important to have someone who tells you, no, this is not the right thing for you. And that's why we say that personal finance is more personal and less of the finance stuff. Yeah. So this is the role that we play in our client's life. And we actually take care of our clients' money the way we take care of our parents and our best friends' money. So that's something we have lived up from day one. And Amar has instilled and drilled in all of us, so the entire organization follows it out. Yeah. So moving on from here. Yeah. So introducing our today's speaker, dear founder, Amar Pandit. So Amar, so before I come to MFA story, I'll quickly, read out the key important stuff. So Amar is a CFA charter holder from CFA Institute. He's also certified financial planner. He is also the alumnus of the Wharton School. Amar is founder of several companies, and these companies actually came into existence because he really believed in making a happy difference in the lives of the people. So he's currently the founder of MFA Capital and Happiness Factory. And the Happiness Factory, like Dr. Neeraj, what you asked, is a world-class goal-based fintech platform, which investors use it to, to understand, basically they input their goals, they track their goals, and they understand how far have they achieved in their goals. It's just like like even Sachin Tendulkar has a coach who tells him, how far he's best in terms of his capability and skill. So you can actually compare this with that. Then Amar is very passionate about spreading financial literacy. He's written 5 books and 1,000+ columns. And these are the 2 blogs where every week he curates interesting stuff. And his latest book, Happy Rich Advisor, is meant for all the financial professionals who are planning to build a wealth management firm. Yeah. So very briefly, I'll talk about how MFA started. So in the year 2001 till 2004, Amar was in US, and he was handling the North American operations for the financial and banking company. And during that time, he felt that no, he needed to do something that he's really passionate about. And the only answer that he got was that financial planning and wealth management is something that was very close to his passion. And at that point of time, he said that is US a good place to start the practice? And when he saw the way the financial planning and decisions were taken in India, there was absolute rampant mis-selling of insurance, policies, mutual funds, stocks, bonds. And he said, this is the place where I can make a difference. And he decided to come back to India. And he was thoroughly convinced that he will get the set of audience who will listen to him and who will appreciate, working in their best interest. And I would say he believed in creating the company with the philosophy, the simple but a very powerful philosophy that honesty is the best policy. Yeah. So, and Amar started with one man army. And we all who believed in his philosophy, we all joined. So me, Chitra, and a lot of team members who wanted to add a value in our clients' lives are the ones who joined the firm. Yeah. So that's about Amar. We welcome you. And I will now introduce my panelists. So we have 4 doctors, and thank you so much, all the doctors, because the moment I called them up and said that this is something that we are doing, and they all readily agree to contribute and give their time. So our first panelist is Dr. Taral Lagra. So Dr. Taral has been with MFA for the last 2 years. Yeah, for the last 2 years. And I remember that whenever we had any doctor practice strategy that we want to discuss, I used to ask him for time, and he said, yeah, sure, Meena, we will do it, at this time. And he was always there to hear us out and give us a very honest feedback as to what changes that we need to do. And so Dr. Taral is one of the best and renowned pediatric orthopedic surgeon with special interest in pediatric hip, cerebral palsy, and deformity correction. And beyond that, his interest is in farming. He's a tech geek, I would say, and reading. And I'm sure people who would have attended his, we had, I think 6 months back, a session on farming, and we all thoroughly loved it. So welcome, Dr. Taral. Thank you so much for being a part of this wonderful, insightful, excited session that we all are looking forward to. Yeah, moving on. And then I said, you are such a soft-spoken, humble, and a down-to-earth person. And he said, oh, is it? But that's what you are, doctor. And Dr. Bhushan is extremely focused when it comes to his goal-based planning. And he's been there with the MFA for the last 1.5 years. And Dr. Bhushan specializes in corrective knee surgeries. Moving on to our next panelist, Dr. Mandar Agashe. I would call him a very dynamic young pediatric orthopedic surgeon, director at Agashe Hospital. And when he joined in, I still remember the first meeting where I met Dr. Mandar and Dr. Prachi, and I told them, this is the way how we do the planning, this is the goals, and this is how entire thing needs to be done. And seriously, they sat down, they did the entire exercise activity. And so it's so nice to see, when people are really focused in achieving their goals at such a young age. So welcome, Dr. Mandar. And moving on to Dr. Neeraj Bijlani. I'm sure Ortho TV, this is a very familiar face on Ortho TV, Dr. Neeraj. Dr. Neeraj has been there with us for the last 4 years. And even Dr. Mandar has been there with us for the last 3 years. I missed mentioning about that. So Dr. Neeraj is there with us for the last 4 years. And in the last 2 years, I think we had the maximum interaction with you, Dr. Neeraj, where we used to interact with each other on what kind of webinars can happen and what kind of sessions can happen and how we can add value, during the lockdown time, and what are the meaningful content that can be presented. So thank you so much for all those feedback and insightful stuff that you shared with us. Moving on to the professional side, Dr. Neeraj Bijlani, consultant orthopedic surgeon, and has his own clinic, which is called the Orthotech Clinic in Chembur. He is absolute tech enthusiast, and he has taken various lectures, conducted a lot of seminars on technology as to how that can help doctors since 2011. Yeah. So with this, we will start and open our today's session. Yeah. So can we start with Dr. Taral? Dr. Taral, you can start with your questions. Yeah. So the way the format of the session is, the doctors will be asking questions from her, and you can put down your questions in the question and answer box that is there. We'll be taking those questions at the end of the session. And whenever, so this is the format in which it will go. So after, I think so, 9 questions are done, we will open it for the questions to be, whatever questions that have been put in the question and answer box, that will be answered. Yeah. So we'll start the session. So over to Dr. Taral.
Yeah. So I'm very happy with this session, and looking at the age group of the doctors on the panel, I just really want to say that this is the age to start your financial planning. Not when you're Dr. Ram Prabhu's age, but actually when you're much younger than that. And I'm very happy that all of us are here as part of the panelists here. Okay, so my first question, Amar, is that, as doctors, we look at vital parameters, pulse, blood pressure, respiratory rate, and the market's vital parameters are Sensex, Nifty, all those indices. Now, if you see the indices from last April, blood pressure of the market 30,000 to 50,000 beyond and 50, what it's heading towards. And what do we understand out of this, as doctors, how is the health of the market, and is it going to survive? So Amar, please guide us on that.
Sure. So normally the first question that I always get is, where is the market going? Where is the market, head? So I'll first kind of address that, Dr. Taral, and move in, contextualize that, to the question that you've just asked. So the first answer that I always, tell people when they ask where is the market, headed, I am like, I don't know, what the market is going to do tomorrow, but I surely know what the market will do, ultimately. So for example, what do I mean by that, right? So I ask a very simple question. What do you think would be the next, where do you think would be the next 300% move in the market? Would it be up or down, right? So the answer to that is that the next 300% move in the stock market would be up. It's not going to be down. What about the next 200% move? It's going to be up. What about the next 100% move? It's going to be up. What about the next 25% move? It's going to be up. What about the next 50%? We don't know. What about the next 20%? We don't know. But we are investing in the market, not for the next 20% move, but we are investing for the next 300, 400, 500% move. So it truly does not matter what the market is going to do tomorrow or day after tomorrow, right? But what matters is that what it will do ultimately. And ultimately, the market over the long run is always going to go up. Now, in the context of the health question that you asked, that when doctors look at vital parameters, right? What are the vital parameters when it comes to financial planning? So the vital parameters when it comes to financial planning is not about the market, is not about the Sensex, is not about the Nifty, right? But vital parameters are all about your cash flows, about your net worth, about your assets, and importantly, it starts with your goal. And one of the critical parts there is that we try and answer for every family is that how much is enough, right? Because that's the classic question that many families are trying to get and handle on, that how much is enough for me. So the most important vital statistic, if I have to say that there is one metric that you must track, that is how much is enough. What is enough? What is that number? What's that number for every family that's going to take care of all your financial goals and allow you to live the life you have imagined your money? So that's the key metric. And whether when you talk about P's, is the market too expensive? Is the market too cheap? That fairly and frankly does not matter. So for me, the metrics is that, are you clear on your why you invest? So the why of investing is far more important than the what of investing. So the metric here, like I said, is the first metric is how much is enough. Then you move on to your cash flows. Are you saving enough, right? So for how much is enough, one of the other metrics that is going to be very crucial is that how much are you saving, right? So it's not important how much you earn, but what's important is what are you saving? Are you saving at least 25% of your gross income? That's a vital metric to kind of track. Then the third metric that I would talk about, where are you putting this, right? Where is your saving? So is your saving going in a savings account, or are you investing in the stock market? What rate is it compounding at, right? So the metric there would be, what is your compounding rate? Are you compounding at 5%, or are you compounding at 2%, or are you compounding at 12%, right? So these are some, and none of these metrics related to market. So frankly speaking, it just doesn't matter where the market is kind of headed tomorrow, because I know where the market is headed ultimately. And like I said at the start, right, the next 300% move in the market is always going to be up. It's not going to be down, right? Because the market can't go down below 100%, and the market will never go down 100%, right? So while we can think about a 20% dip or a 30% dip, but the next 100, 200, 300, 400, 500% moves are going to be up. So I hope I answered this question. So feel free to. Can you hear me, Dr. Taral?
Yeah.
Am I audible?
Right.
So
Yes.
yeah,
Yes,
Amar,
Meena.
there was I think you can switch off your video, Amar. I think the quality
No,
in
we need
between
the
there is a
expressions.
lag.
The
Yeah.
voice does not lag. Don't worry, Meena. The voice does not lag. We need his expressions. That is very important.
Okay, that's fine now. Okay. Okay, fine.
So,
Yeah.
Meena, can I ask, the question which
course.
really comes to my mind
Yes,
after this?
please do that.
And this
Please
is,
do that.
yeah. The question is, Amar,
Yeah,
you
please.
spoke
Yeah.
about how much is enough and how much saving is enough. And we always do our financial planning or saving, looking at good things in life. My children's education, unki shadiyan, I'm going to buy a bungalow, I'm going to have vacations, foreign trips, I'm going to expand my nursing home. And people plan finances for them. And just 6 months back, I experienced something where, I had an accident and, there is loss of income. COVID times, there were situations where doctors were not doing well. There are sickness in a family, even in a doctor's family, takes you down in your complete sort of a planning. So people invest for good things in life, but are we prepared for that rainy day? And how do you plan for that? I wanted to ask you.
Sure. Excellent question, Dr. Taral. One of the foundational, elements of planning is that you always start with contingency planning. The first thing before even you start to invest for your goals, right? Like you said, for the good times, even before you start you investing for the good times, the first thing that we have to do is that we have to invest for the bad times. That the first is create a solid foundation. So we have a goal called as contingency planning. We have a goal called contingency reserves, right? Where even if somebody was out of work or without income for the next 18 months, you should be taken care of, because that's the first thing that you need to plan for. So plan for the bad times first. So cover your foundation, cover all your risks, right? So one is that you can self-insure by ensuring that you have at least 12 to 24 months of your liquid reserves available that you can dip into at any point of time. So that's the first thing that we always say. Second is to not just self-insure, but to go in for a medical insurance, have a life insurance, ensure that if you are hospitalized, you have something to fall back on. And you should take as high a cover as possible on the health insurance side, right? So first, always plan for the bad times first. And once that's done, then you look at investing for your goals. And that's the right way to, plan. That's how we kind of, do. And when you plan, you just factor your personal expenses, but you also factor your practice expenses, right? You might have to pay salaries, you might have to pay, rent, especially in 2020. So when COVID hit, one of the foundational things that we had done long time ago ensured that none of our clients, had to even dip into their reserves. I mean, they planned pretty well, and even some of them they didn't have to liquidate any of their investments at all, right? And so the first thing, like I said, is plan for the bad times. You invest for the bad times, have a solid contingency reserve that will come in handy.
So did that answer your question, Dr. Taral?
Absolutely.
Yeah,
Thanks. And this was planned for me. I'm really glad. After meeting MFA team, I increased my medical insurance, took a term insurance, and also we had planned contingency planning, and that really helped. And that makes that event stress free. When there is a bad time,
right,
the major stress is financial, and that takes it away completely. Thanks to MFA team for that.
Yeah. Thank you, Dr. Taral. Dr. Bhushan,
just to add a point, Meena.
Yeah.
Just to add.
Yes.
Yeah, Meena, just to add one point here,
Yes,
that
Samarth, tell
the
me.
whole purpose of planning, yeah, so the whole purpose of planning is to help a family you achieve their goals, whether in good times or in bad times, right? And that's the essence of planning, that things always don't go the way we plan, and the process of planning is far more important than a financial plan. So I always tell people, don't obsess about a financial plan, because the process is far more important than the, because as we've done the plan, the assumptions change, right? Things could happen, life happens. So the whole point is that the plan has to be current at all points of time. So you need to update that plan. So following that process of financial planning is far more important than the financial plan itself.
Okay. Yeah, Dr.
Yep,
Bhushan,
Meena.
you want to?
Yeah, so that's nicely put, Amar. That's really useful information just now. I agree, planning is very important. We are bombarded with so many advertisements, so many advices from people about right time to invest. When the market is going down, there should be a dip like this when you invest, or when it comes down, you invest. So it's a pretty confusing thing. So it's something which I can't get my head around most of the time, when to invest. Moreover, the very fact we are doctors means our maths is very poor and commerce knowledge is very, very poor. So at least for myself, sorry other guys, but so it's important for someone to literally tell us exactly when to invest. Or is there anything like that? There is a right time to invest. You get ads which say SIP. There are ads which say no, bulk investment is better. Some older generation people say go for fixed deposit. They're the best. So when is the right time to invest according to you?
So that's a fantastic question. And that's, again, a very common question, Dr. Bhushan, that I always get. And I have a very simple answer for that, is that any time is a great time to invest, provided you have a time horizon that is long enough, right? What I mean by that is that, let's say you want to invest in equity and your horizon is just 1 year. It's not a great time to invest, even if everyone in the world is telling you that you should invest. But if your time horizon is just 1 year, then it's not the right time to invest, for you. But the money that you require, any money that you require after 10 years, after 15 years, if you have as long a time horizon as possible, more than 10, 15, 20 years, then any time is a great time to invest. Because what truly happens is that you are allowing compounding to work, for you. And compounding takes time. And compounding is the eighth wonder of the world, right? So the whole thought process is that if you have a time horizon of less than 3 years, no time is a great, that time is not a great time to invest in the stock markets. Now, you might be lucky once, you might be lucky twice, but that does not mean it's the right time. It's just like, let me give you an example. So we cross a red light, right? Once, twice, thrice. We don't stop at the red light, but we just cross it once, twice, thrice. But that does not mean it's right. We might be lucky, right? But the fourth time might not be lucky. So if your time horizon is short, extremely short, less than 3 years, I wouldn't say that it's a great time to invest. But if your time horizon is long enough, any time is a good time to invest. So I hope I am able to answer that question well. Feel free to
how
ask.
the market is going is not relevant at all?
Absolutely not. Absolutely not. Because, one of the things that I would like to say is that people lose more money waiting for corrections than in corrections themselves, right? Peter Lynch had kind of said that line, that a lot of money is lost waiting for corrections. Now, just think about the last 18 months. Everyone is still waiting for a correction. A lot of people are still waiting. And so one of the important statistics that we need to understand is that the markets are of the time, right? 70% of the time they are up, 30% of the time they are down. And in between these two numbers, they can be sideways. But majority of the times you see that the markets are up. So waiting for the market to correct is a losing strategy. So one of the things that you could also obviously do, invest through SIPs. But if you have lump sum money, you should invest it as fast as possible. Don't wait for 2 years to invest in something that you have today. obviously, continue with your SIPs, you invest through SIPs, but if you have a lump sum amount to invest today, you should invest it as fast as possible. And one of the things that we see is that, let's say today the market is at, the Sensex is at, let's say 54, and the market's correct by another 5-10%. Great time to deploy. Having said that, like I said always, that your time horizon should be as long as possible, and that's the key that you got to keep in mind. And with that, if you have that, I think there's nothing to worry. Absolutely nothing to worry.
Okay.
Yeah. So I have a very important and pertinent question. So we run these Ortho TV doctor finance groups where a lot of doctors are part of it. And we started this during the lockdown a few months back. And we have also been following some groups where some doctors tell us that you are doctors, you are very intelligent people. Why do you want to do why don't you do direct mutual funds instead of going to a professional? So what is your take on it?
So my take on it is very, very, very simple, Dr. Neeraj. I mean, it's what does direct mean? I always ask people, what does direct mean? I mean, it means do it yourself, right? It means do your own surgery. It means do it, in the context of doctor. It means that why do I need a doctor? I can do my own surgery, right? So direct essentially means you go direct and you invest. Whereas I always have this feeling, and not just a feeling, but a belief, that the professional is far more important than the tool that he uses. Now, for example, in the context of orthopedic surgeons, now what's more important are not the tools that you use, but what's more important, that you are far more important than the tools that you use. So when you go to a professional, when you seek professional guidance, what are you going to a professional? Are you going to him for the tools? No, we don't go to professionals for a tool, right? So when somebody, comes to us, it is not that, so a mutual fund is a tool. Right? So the value of a financial professional far, far, far exceeds the tool that he uses. But if he just want access to tools, yes, there are various sources available where they can go and access these tools. But if you want a surgery, if not just a surgery, but if you want, holistic financial planning, if you want financial counsel, if you want financial guidance, if you want somebody to guide you on your financial life, so your financial life is extremely, extremely valuable, just like our physical lives are valuable, right? So the whole point is that, you are entrusting your financial life to a professional. You go and seek their counsel. So that is where, it's been made absolutely frivolous by a lot of people saying that, "Arey, direct karna chahiye." It's like saying, "Boss, mein direct surgery kar lo." It's like sab kuch direct kar lo. Can you do it? Yes, you can do it. Right? If you feel that you are as good or better than a professional, anyone can do it. Right? But it's not, because this is what we do for a living. Just like you do surgeries, you are one of the best. All of you are the finest in the country in your field. Likewise, in our profession, we are, right? So the value is never of the investment or the tool. The tools that you use have no value. So mutual funds or the tools that you use have absolutely no value, but the professional has. So that would be my response. And, people can make their choices accordingly in terms of what's valuable to them. If they want a tool, then you can go direct. But if you want financial counsel, if you want financial, guidance, if you want a solid world-class professional to be on your side, to be your coach, then go to a professional, then go to a real financial professional. Because today, sir, there are a lot of fake professionals around. Har koi bolta hai. Even in the doctors, fraternity, what I've seen, even though I might not be a doctor, but I still have an opinion. I have Google. I can go and, ask you a few questions. Ye kyun kiya, ye kyun nahi kiya. But the point remains that the value of expertise, the value of, professionals is way, way, way beyond that of tools. So I would say that each family, each person has to make that choice for themselves in terms of, do I want the tools or do I want the professional? And that's what this business is all about. So that would be my answer. So hope I was able to articulate it well for you.
Yes. So somehow, see, there may be people who are still unconvinced. So as a doctor, I would like to add just one comment. So there
Amar,
may be, yeah, there may be
I would
one
add
or
to
two.
this.
So there may be 1 or 2% of people who are very active in our groups, who are able to do their stock trading, intraday trades, whatever different types of trading. Forget the direct mutual funds. They can even do this. But that is, they have taken this up as a passion, like how technology is passion for me and Dr. Taral, and pediatric hip is a passion for Mandar, and the specialist knee surgery is a passion for Bhushan. So that is something which they do. But a common doctor or a common orthopedic surgeon cannot basically day to day do those studies, do those tradings, do those direct mutual funds. It is very difficult. So like you don't like the patient asking for you don't like the patient trying to take medication on their own without a prescription. So you should also not invest in mutual funds without a prescription. And that doesn't mean that you go to your agent. Yeah. Yes, Taral, sir.
So, yeah. So I would say that self-medication is injurious to health, and self-investing is also injurious to your finances. One more thing I would say is when you are not equipped, when you're not, it's not a passion for you and you try to do it, it's stressful. And here it's giving your financial stress to somebody, which is so much important. Which is also an important point. It's not only injurious to your financial health, but also mental and physical health. Self-investing. That's what I would say.
So that just brings us perfectly to what I wanted to ask Amar, is how one should select a professional for investment. The reason I'm asking is, as you heard, all of us are specialists in one branch. So is there a specific professional for a specific branch of investment, or you should rely on just one financial advisor, or you should have multiple advisors, or you should take opinion from people? The reason I'm asking all of this is that I just would like to share a small snippet of information. I have been investing for the last 4 or 5 years based on advice of my own banker, and ultimately realized that 80% of my investment was in one type of mutual fund of the same bank. So if the bank goes bust tomorrow, I'll be screwed. So I just need to know exactly how a financial advisor can be selected, or how do they go about investing or distributing the money properly in this.
Amar, you're there? Yeah.
Yeah, I'm there. Yeah. So one of the most important, things to do is to have a meeting, right? So the first meeting experience will, tell you a lot, right? So, is the professional, or is the banker, or is the person trying to understand more about your financial life, or are they trying to articulate more about how good they are, how good their research is, how good their products are, how good their performance is, right? So I would say that the first step is about client experience. So more than what they actually tell you, you should focus on what they are asking you, right? So the kind of, questions that they ask you, do they make you think? Do they challenge you? Do they, after the conversation, do you feel far more clearer about your, financial goals, or are you more confused about where to invest, right? So the clarity in the first meeting, or the client experience, as I always say, is far more important. So when you have a conversation with a financial professional, with a real financial professional, you are absolutely clear about your financial life, and you when you walk out of the meeting, it's like, wow, this is the first time I've had a meeting like this with someone in my life. So I'm sure, and that when you had a meeting with Meena, or one of my colleagues, the feeling that you would have probably left out with was like, wow, nobody has ever asked us this, right? I have never gone through an experience like this. So the first thing that, I would say is to identify a financial professional is the kind of experience that you go through. What are the questions that they're asking? What are the questions that they're asking you? Are they really genuine? Do they come across as somebody genuine? the red flag there is, do they talk about products in the first meeting? Are they trying to sell you something? Do they come up with a form? Do they come up with something and saying that, look, invest right now? Are they saying that you have to invest right now without even diagnosing you? So like the first thing, one of the most critical points is that how thorough is the diagnosis, right? Do you feel diagnosed enough, right? So it's like when I go to a surgeon, when I come to you, I need to feel thoroughly diagnosed, right? Because, if you tell me when I just enter the room, aap ye surgery kar lo, aap ye kar lo, this is what you need to do, without even truly understanding what my needs are, so that's something that I would always, say that, are you feeling diagnosed enough, right? And what was the process that they use, right? Did they have a process? Did they, have a process of asking you questions, making you think, bringing in some clarity in your financial life? So these are like some of the things that are very, very, very critical. So the first meeting thus becomes very, very, very important, right? So, and like I always say, is diagnosis is absolutely key. That if anyone recommends you a product without thorough diagnosis based on performance, I mean, that's not who you want to go with, right? So that's a clear red flag. Now the markets might do something, but what's happening in your financial life, right? What in the market is not important. What's happening in your financial life is far more important than what's happening in the market. So I always say that the client experience, the diagnosis, these are parameters which are extremely critical. And, you should leave the meeting with the feeling saying that, like, wow, this is clarity and made me think, right, about financial goals, because nobody really talks about it. Nobody really asks these like questions. And a great diagnosis session should last at least for 1.5 hours. And, I'm not saying that's a norm, but even if you feel pretty happy after just 30 minutes of a conversation with someone, that's great enough, right? So it all depends on the experience of the profession. And then obviously,
Amar, we lost you. You can hear? Hello? Hello? Dr. Mandar, you can hear me?
Yeah, I think
we
we
can
have
hear you.
lost Amar.
Yeah, I think, we lost Amar. I think his,
Just one.
We'll just wait for him to,
Yeah.
Amar, you are there?
So, Meena, till the time
Disconnected.
He's
Amar comes
weak.
back.
Yeah, he's coming back.
We can you answer? Yeah, he's come back. Okay.
He's come back,
Hi. Sorry, I just got disconnected for a couple of seconds.
Yeah.
Dr. Bhushan, I hope I answered your question.
Yeah. You covered
It was a
everything, and
technological CPR. Yeah.
that's exactly what my experience was with you guys. So I think rather than just being told, put this much money here, I was actually asked, what are your goals? What do you want to achieve? And I agree with everything that you said. Well said, actually. I couldn't have put it better than what you did. Good.
Great. So, Dr. Mandar, you want to answer?
Thank you.
Yeah.
And just to add one more point, sorry, go ahead.
Yeah. So
Go ahead.
just to bring on my investment story, I started investing probably 4 or 5 years back, and it was an extension of what my parents had invested. And initially, so like a typical Maharashtrian family, the investments were in FDs and LIC policies and stuff. So and which was the norm for that age, which we now realize that it is now outdated, right? And now we have various other means, mutual funds and PMS and stuff. So how do we ensure that the instrument which we are going to invest in remains up to date and it doesn't become outdated as time? So there are various new things which come up. So how do we ensure that we are investing in the right place?
Right. So, like I said, everything first starts with your why. That the why of investing is far more important than the what of investing. So everything starts by why. I mean your goals, your financial goals. Once they are defined, then there is the concept of, how. So first why, then how. So what is the process that you are following to plan for each of these goals, right? So the first is why, which is your goals. The second is how, which is that the process that you follow to invest. The last is the what, which you asked, right? So the last comes what. What should I go for? Should I go for mutual funds? Should I go for PMS? Should I go for something else? But one of the fundamental things to kind of realize is the concept of asset allocation. Because what is a mutual fund? A mutual fund is basically just a pass-through vehicle, right? So that kind of allows you to invest in equity, allows you to invest in bonds, allows you to invest in liquid assets, so or even gold. So basically it's a structure, it's a tax advantaged structure, but ultimately what matters is not whether you are investing in XYZ product, but you also that what is the asset allocation that you have. And I always recommend friends, clients, everyone to keep it as simple as possible. Now, simple does not mean it's easy, right? So there are now a lot of people can say that there can be a distinction between, PMS performance can be far better than a mutual fund. This is the latest product that I have. The more it is, the more but also complexity that it has. Now, just to give you a comparison, now let's say a fund has got 45 to 50 stocks in its portfolio, whereas a PMS has about 15 to 20 stocks in its portfolio. Now, what does it mean? Now, if that particular PMS outperforms for a certain period of time, now that PMS has taken far more risk, right? Far more risk to deliver that performance. But generally, if you see over a period of time, over the last 20 years, 30 years, mutual funds have outperformed every other investment type, right? So even in India, a mutual fund is a relatively a new kind of an asset. And innovations that need to happen should not happen in terms of structure, whether it is, mutual funds or PMS. That's not innovation. Innovations happen in terms of asset classes. Now, Bitcoin, it's a new asset class in itself. Right now, the market capitalization there is almost $2 trillion. Right now, that is innovation. That's a different type of innovation. That is real innovation, where a new asset has been added to the asset class. It's not the mutual fund versus PMS versus AIF. That's not innovation. That is adding complexity, that is adding more cost, that simplicity is the ultimate sophistication, right? Leonardo da Vinci has said that. So the whole thing is that keep it very simple, and a mutual fund can give you access to pretty much everything that you require. And it's not just in India, but even globally, when you look at it. So innovation needs to be looked in the context of not the structure of the product, but it needs to be looked in the context of the asset class itself. And that's how. So you don't miss out on the real, stuff that's kind of happening. So I hope I was kind of, clear on that. Thank you.
Yeah. So Mandar, we answered your question, no?
Yes.
Yes. Okay. Perfect. Yeah. So Dr. Neeraj, you want to ask your question?
Sorry. My question is, as everybody says that when is the right time to invest, the right time to invest is now. I tell this to everyone that today, now, immediately, you write down the check, do the transfer, do it now, even if it is off market. But I have now been invested for 4 years. And I want to ask her exactly opposite question. When is the right time to book profit, or when is the right time to sell? Whether to book profit, to stop your loss, when is it?
So, I have a slightly perspective on that, Dr. Neeraj. So so I will answer this question by saying that the right time to sell, there are only two times. right? One is when you need money for your financial goals, and you need for specific need that you have, or that you had planned for it, or it's unplanned and need some money. That's one time to kind of sell. The second time is that if a particular investment is underperforming for a certain period of time, there have been changes that have been done, there have been corrective actions that have been taken, but still it's not doing well. That can be the second, though I would use that very sparingly. Very rarely would I use the second option. So the first and only one answer to this question is that the only time to sell is when you need money. Because if you sell in the name of profit booking, in the name of any other label that you have, then you are basically interrupting compounding. Because then the next question that you have to ask yourself, let's say I book profits today, what would I do with that money? Right? Will I then to reinvest? Will I consume that? What would I do with that money? Now, if you again are talking about that I need to reinvest this, then you're introducing timing risk into the whole equation. So I always tell people that don't interrupt compounding. Compounding is the eighth wonder of the world. And I have a chart that I would probably tell Meena to kind of show it to everyone at a certain point of time, but not now, towards the end. But the whole point is that compounding is so powerful, and when you sell, you interrupt compounding. And if you interrupt compounding, then it doesn't truly work for you. So my only thoughts, which I am fairly convinced and I am very, very vocal about, is that sell when you need money. Sell for your financial goals, right? Everything else. And yes, I missed one point, which is called as rebalancing, right? So let's say you have an asset allocation with a 60% equity exposure and a 40% debt, right? And that's the kind of portfolio that has been constructed for you to achieve your financial goals. Now, if the markets have gone up significantly, and you have reached now a 85% equity and a 15% debt. Now that's the point of time to also rebalance. So what this basically does, that you are selling high and then you're buying low, right? And that's what we ultimately want when we are investing. So that allows you to rebalance, sell 25% of your equity and buy debt if you kind of want that. So rebalancing is another area, but again, there you have to keep into check the tax impact of your rebalancing, right? So when you sell something, there are a lot of costs. There are direct costs, and then there are hidden costs. So the direct costs are obviously taxes, right? And transaction costs, taxes. These are direct costs. Then there are hidden costs such as market timing costs, right? So if you sell at, let's say a lot of people sold at 40, a lot of people sold at 45, they're still not in, right? So the cost of not getting back into the market on time is a cost. Now that's a hidden cost. A lot of people don't kind of consider that. So my answer would be, when you need money for your goals, that's one. You're rebalancing, and third is very rarely, if for an extended period of time. So these are the only three times that I would probably say. Other than that, don't interrupt compounding. Let compounding work for you.
That's very good. Just a small extension to my question is that if I have to buy a depreciating asset, it could be for my business or for my personal reasons, is it better to take a loan at an interest rate of say 7 to 8% versus redeeming your mutual fund and going to buy that asset without a loan?
Yeah, so the clear financial answer, or the clear logical answer, is to take a loan and not to redeem your funds, right? So that's the rational financial answer. But human beings, we are all very emotional. We have our own comfort levels. Right? There are a lot of people who are not comfortable with debt, right? अरे यार वो लोन नहीं चाहिए सर पे. बहुत लोगों को ये लगता है कि लोन नहीं लेना चाहिए. So there is nothing right or wrong, but the clear logical answer is yes, of course, take a loan. If you are getting at 7 to 8%, and here you can probably earn a yield of like 12% over the long run, it's a financial no-brainer, right? When it comes to, like, there are a lot of people who might not be comfortable with debt, then they can, probably sell and even do it, right? Because there's nothing right or wrong. I mean, so it completely depends on what your mindset is. If you are comfortable with debt, that's the right thing to do. But if you're not, then you can probably, sell and do it.
Okay. Thank you very much.
So
Yeah. So we answered your question, Neeraj.
Yes, very well, very well.
Yeah. Thank you.
I'm going to take a loan for my car.
Please do that. You should. Yeah. So Dr. Taral, you want to ask the next question?
So, what is the best time to invest? That's a question I wanted to ask. That which is the golden period to invest in your life? Is it dependent on market? You answered that question, but I would like you to again put things in order, because as smart investor we always feel that जब market नीचे होता है तो invest करो, ऊपर जाता है तो sell करो. So some more tips on that.
Sure. So I mean, the best time to invest, Dr. Taral, is as soon as you can, because like I always tell people, is that time creates money, right? Time literally creates money, and that's the power of compounding. So the sooner you start, as soon as you start earning, even if it's as low as 5,000 rupees, right? So it does not, matter that, you have to invest a couple of crores, etc. All of that you have to wait to accumulate a couple of crores and then you invest. Even so, start as soon as, you can. Let time work for you. Let time create money for you, because time creates money. There's a statistic that I always share with people, that let's say somebody were to invest 5,000 rupees when he was 25 per month, and he would continue that for about 35 years. By the time he's 60, this gentleman could have about 3.5 crores, close to 3.5 crores, right? So that's the power of compounding. Now, how much have you really invested? 60,000 rupees per year. For 35 years, you've invested close to 21 lakhs. That's it, right? And you've not even increased your investment over 5,000. Now, the key there was time. Time creates money, right? So have that discipline to stay invested. More than what is the best time to invest, the question should be, how long should you be staying invested for compounding to work for you? So like there's a cliche, right? Your time in the market is far more important than timing the market. But that's absolutely true. And that's something that I would say, that don't wait to invest and have a time horizon that is long enough, so that compounding can create money for you. Time creates money. So that is a very powerful statement, but a lot of us, viscerally don't kind of, get it, but yet it's very powerful that time creates money. So I would say that any time is a great time to invest. So start as soon as you can. Anything that you can save, go for it.
So, one corollary to this was that, which is the next best decade of opportunities, and that's the next one, the one which is immediately coming. Isn't it true?
Okay. So I've been an India bull throughout. And that's one of the reasons why I, you came back from the US. A lot of people told me that you're an idiot to go back to India and to start this firm. But, I was very, very, very bullish about India right from 2004, 2005. One of the things that I personally feel is that though we lost the last decade, right? Though we lost the last decade technically in terms of from 2010 to 2020, but even then the markets have delivered fairly well. But I think this decade, 2021 to 2030, belongs to us, right? There are a lot of geopolitical reasons for that, but more than that, there are a lot of fundamental and like structural, I would say, foundational elements that are there in place, like whether it's the rise of the middle class, right? For a country to deliver outstanding GDP growth, etc., all of that. So whether it's GDP growth or any other parameter that you kind of look at, I would look at is how is the middle class growing, right? Is the rise of the middle class kind of happening? Because that speaks volumes about any country. And if you look at India today, we are very, very, very well poised, though we lost the last decade, but I think the best is yet to come. So 2021 to 2030, we would be surprised. The first $1 trillion of GDP for our country took us several decades, right? So in 2007, we crossed the first trillion, right? Then the second, trillion, we took 10 years. We crossed in 2017, right? So the first trillion from all the way from 1947 to 2007, you could see how many years it kind of, was like. But the second trillion took us 10 years. The third trillion took us 4 years, right? So the first 3 trillion, right? So every trillion that kind of gets added, right? So I would say that the next decade, there's a lot of projections, a lot of studies that have been done, a lot of projections about that we will reach $10 trillion of assets in terms of GDP, in terms of GDP of the country. And structurally, the market mirrors GDP. So if I were to assume $10 trillion in the next 10 years and your GDP of 10 trillion and the market cap, that is the market value of all the stocks is 10 trillion, then we are talking about going up by at least about 3.3 times from the current new levels. Now, that's not a prediction, that's not a recommendation, that's not advice, there's nothing, but I'm just making an observation saying that the markets at least have to go up by that much. So the whole point is that this is a decade, and I am pretty bullish over the next couple of decades. There's a whole lot of growth that's there. And one of the fundamental statistics that I must share with you now, if you look at the US economy in terms of GDP, that's about $20 trillion, right? Whereas the size of their asset management space and everything, that's almost about $49 trillion. So which is 250% of the GDP. Whereas here in India today, the size of our asset management space is barely a fraction of the $3 trillion that we have. The size of our space here in India today is about 400 billion to about 450 billion. So roughly about 13% of GDP and of the market cap. So we have a long way to go in terms of even domestic investments coming into the market. So if you see the average SIP book today of the industry has reached close to 9,000 crores per month, 9,200 crores per month, which means about 1,10,000 crores being invested every year through SIPs. And that number is only bound to go up. So you are going to see a lot of even capital flow from domestic investors in the markets. While once upon a time, and even now, we were dependent on FIIs, and we are going to be dependent on them for a certain period of time, but that's likely going to change probably 10 years down the line. So we will see a lot of domestic participation happening. So I would say the next couple of decades are great, and we hope compounding works for all of us.
Thanks, Amar. That's very encouraging. Thank you very much.
Yeah, Dr. Minder.
Amar, so I'll be talking on behalf of probably Neeraj and a few others who are hospital owners, also have their independent practices. So now the question is, how do you choose between investing in your own hospital versus investing in the personal space? As you know, the hospital expenses as well as hospital investment is quite a lot. So how do you divide your finances into that? How do you choose a percentage? How do you come to terms with it?
Now, there is, to my mind, there is no single formula here, but it has to be tailor-made. It has to be, customized for pretty much every doctor, right? And it's a function of several things. It's a function first of your personal goals, right? So what are your business goals? what are your personal goals? Because your business goals ultimately this is going to drive your income also, right? So from here, if you're investing today in your hospital, you are assuming that your income is going to go up, right? Your value of the business is going to go up. So first is, so there are two distinct parts, right? So one, when it comes to business, you must have absolute clarity about why am I doing this, right? Do I hope to build a hospital that I intend to sell at some point of time, in the future, or am I doing this so that my children can take over at a certain point of time? So the objectives, the goals need to be very, very, very clear, kind of there. And what are the economics of running the hospital, right? So that's something that you have to come to a conclusion. So once you are clear on that, then the next part is about your personal finance. Having said that, you will have personal requirements, that you will have goals, you will have 4, 5, 7, maybe 8 goals, right? So how are you going to fund each of those goals? Now, once you have ensured that this is how you're going to kind of fund these goals, then it's a clear choice that you have to make. Now, once all your goals are funded, all the key goals that you're funded, now for example, your retirement is one of your bigger goals. But for most doctors continue to work, right? They never retire. I mean, very, 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 very few surgeons do retire, right? But majority of them continue to work till the age of 70, 75. I've seen doctors working till 79, right? So, so from that perspective, one of the things that you have to ensure is the business allocated to my retirement goal? Might not, right? So when you plan, you have to ensure that first all your personal goals are also kind of taken care of, or you have some plan for it. I'm saying that you'll be able to take care of it right from day one, but you have some thought behind it, you have some plan behind it. And also when you need to invest for a hospital, you have the economics right. So that am I going to self-fund it? Am I going to take debt to kind of fund it? What's the ROI? How am I going to service debt? What's the addition to my personal cash flow? Or is my cash flow going negative by adding one more hospital? Am I taking far more risk? So all these parameters of like returns, risk, personal goals, have to be balanced, and there has to be a tailor-made strategy for every family that has to be created, right? So it completely kind of depends. There's no single answer. It's like a tailor-made shirt. It's like a tailor-made suit. It has to be precisely kind of done for you.
Can I just add to this? Amar, can I just add to this point? Hello?
Yeah, please.
Yeah.
Please.
So, Dr. Mandar,
yeah,
what we typically, thank you, Amar. So what we typically do now, Dr. Mandar, in such situations, we first, take down, like what Amar said, those key important, why are you doing it? And, what are the key important goals that you have? We understand that. And then we also understand what are the tax implications. So we actually have a meeting with the CA, and it's a group, it's a joint discussion that happens, and then we plan the entire thing. So personal side, these are the things that needs to be taken care, and from the taxation angle, from the structuring angle, what will really make sense. So we marry both of them together, and that becomes a better strategy for the doctor. Because during COVID, we have a lot of doctors coming forward and asking these questions, and this is the way how we went about helping them. Yeah. So that's the approach that we have when we combine the taxation aspect and the personal finance together. Yeah. Okay. Thank you. So, any more question, Mandar? Do you have any question? Any more question? Okay. So, then I have a question, Amar. Since in the conversation we have spoken so much about power of compounding, I want you to probably share about it with all of us, and I will try and see if I can share. I can do my screen share where you can talk about it also. Hello, Amar, you can hear me?
Yeah, Meena.
Yeah. So
yes, I can hear you.
Since you spoke about power of compounding, I just wanted you to share with us how this eighth wonder
If
of
you
the
can
world
share
works.
screen.
Yeah. I'll just share.
Yeah.
Yeah, 1 second. I'm just sharing this slide. Yeah, you can see this, Amar?
Yeah. So yes, I can see it. I can see it. So as you can see me and everyone, so this is how the compounding chart works. This is one of the most powerful charts in personal finance, and one of the things that I always do when I meet some people, and I kind of ask them, but why don't you draw a chart of compounding, wealth versus time, value versus time. I would love to see how people draw this chart, right? And majority of the times people get it wrong, right? Because if you see this chart, that for an extended period of time, you feel like as if compounding does not work, right? You feel as if compounding is not working. It's a very, very, very flat line for a longish period of time. And that period of time can be as long as about 20 years, right? Can be as long as about 15 to 20 years, where you feel that, oh boss, nothing is happening. Why is compounding not working for me? But compounding is working in the background. It's laying down a very strong foundation. And this is not just about you investing. It applies to every aspect of our life. Be it our skills compound over a period of time. The more time we put in, the more effort we put in, it compounds over a period of time. But when it comes to investing, what typically people want is that they want a straight line, right? From time zero, they want the straight line to go up. And that is the mismatch, right? And it doesn't happen like that, right? So the whole point that I always say is that compounding will take time. Compounding, will take in around 20 years. So if your investments are not doing well for 2 years, 3 years, doesn't matter. Absolutely doesn't matter, because compounding will only work for you if you're invested for an extended period of time. One of the observations that I've made here is that 95%, actually it's about 98% of Warren Buffett's, fortune was created over a period of time after his age of 65. He's 90 today, right? He'll be 91 now. And everyone talks about him, right? Everyone quotes him, but nobody follows him. Right. So Warren Buffett's portfolio also has seen a downturn of 49%, 50%, 55%. Right. But the point, a lot of his investments have not worked out. But the point is, did he let compounding not work for him? No, not at all. So the power of compounding is available to everyone, whether you're rich, poor, everyone. Time creates money, like I've said earlier. Right. So let compounding, this is how the growth is going to be. So you need to be super, super, super patient, and you need to be super disciplined about not letting people tell you that it can work any faster, because it can never. And a lot of people, I've seen just say, "Arey, ye yahan paisa dalo, jaldi double hoega." Okay, jaldi double hoega, par phir jaldi आधा भी होएगा. Right. So the whole point is that, this is the only this is the only graph of compounding. This is how it will work always. So, time is not only your friend, but time creates money for you. So don't interrupt compounding. The biggest mistake in investing that people make is when they interrupt compounding. And there are various excuses for that. Boss, market is expensive. Our market timing. Okay, not the right time to buy. Okay, so people end up interrupting compounding when they do all these things. So this is one of the biggest mistakes in your investing, and it has nothing to do with the choice of your investment, whether you invest in a fund, whether you invest in anything, right? The choice is all about never interrupting compounding, that let compounding work for you. So that's what I meant, Meena. So this is the power of compounding.
Yeah. And I actually saw in one of my clients' portfolio, this particular folio was missed out, or, and she invested close to 2 lakhs. And then after probably 25 to 30 years, it became close to 45 lakhs. And she was very surprised. So, forgetting about your investments also works as long as they are doing well. It absolutely works. So I've actually seen this with a lot of my clients. They forget, oh, this folio was there in the account itself. And that's what creates them immense wealth. Yeah. Okay, perfect. So I think Amar and Neeraj, we are done with all the questions that needs to be asked. And so are we open to, we can actually answer questions that are there in the question and answer box.
So there are
And,
some 10 questions, Meena. There are some 10 questions. I think I will take up those if you don't mind.
Yeah, you can take up those, and the panelists can also ask their questions, whichever they feel, that is cropping up in the mind.
Okay.
Please feel free to ask. Yeah.
Okay. So one very basic question is there about fixed deposit by Jayashree Thakore. Everybody says bank deposit is paying very less interest, but in case of hospitalization or emergency, only bank pays fastest, while mutual funds or shares takes time in the payment, 2 to 3 days. Sometimes even more when it happens on a weekend. What is your take on it?
So my take on that is very simple. There are different types of mutual funds. So equity mutual funds will take 3 days, right, for the amount to kind of come to your bank account. But liquid mutual funds are those that you invest in liquid or cash only. They are redeemable within 24 hours. So if I exit today, I will have the amount in my bank account tomorrow. So it's pretty fast. It's pretty it's not just so it can't take more than a day. So it will be in your bank account in a day. And like I said, even in a liquid fund, you have very low rates of return. If you feel comfortable with a fixed deposit, please go ahead with it. There is nothing right or wrong. This is bad, that is bad, or like this is good. The whole point is that if you feel comfortable with the fixed deposit, giving you liquidity within 24 hours, liquid funds also can give you liquidity within 24 hours. For as far as my personal investments, my personal is kind of concerned, I always maintain in liquid investments and liquid funds. And liquid funds, like I said, within 24 hours, they are credited to your bank account. So absolutely, there's no kind of comparison, and you both have absolute similar returns. So there is you can pick your choice. You can make your choice.
Amar, is there any difference in tax implication between the interest you earn on fixed deposit versus liquid funds or debt funds? Is there a difference? So does that affect your ultimate gain?
Not much now. Earlier there was a gap, but based on the tax rules that have been plugged at this point of time, there's not too much of gap there. So liquid is kept predominantly so that it's kind of liquid, so that you can tap into it at any point of time. That's the only function that it kind of serves. And if there is a market opportunity, if there's a dip and you want to put in some more money, you can do it pretty quickly versus a fixed deposit, right? So you can pretty much do it as quickly as a few minutes. So with that said, I think in terms of like returns or in terms of any other parameters, taxes, etc., all of that, they're pretty much at par now. There's not much of difference.
So extension of this question is that liquid funds are debt funds, is what I understand. There is a separate funds which are supposed to be also a safe option. And debt funds means your basically tax benefit only starts after 3 years, does not start immediately. Is what I understand.
So there are different kinds of debt funds, though there are different kinds of debt funds with different types of maturities. So just like you have a fixed deposit with different maturities, whether you have 7-day fixed deposit, or you have 14-day, or you have a 90-day, or you have 1 year, 2 year, 5 year, you have different types of maturities even for debt. Now, when you talk about liquid funds, there is absolutely no maturity. You can put in money today, remove it after 2 days. In fact, it is much better than a fixed deposit, because even for fixed deposit, you have to hold it for a certain period of time, right? Even if you go for a 90-day fixed deposit, you have to hold it for 90 days, right? Whereas in liquid funds, you can put in money today, you can take out money 5 days down the line, 7 days down the line, whenever you need it. There is a thing called as an overnight fund also, right? Where you can invest for a day, invest for 2 days, right? Invest for a couple of days. There are those options available to us as well. So debt funds come with different maturities. The ones that you're talking about after 3 years, they are long-term debt funds, or I wouldn't say just long-term debt funds, but they are mid-term, debt funds, which can be held for a period of, 3+ years, and also long-term debt funds, which can be held for a period of, 5, 10, 15 years, whatever. So debt funds come with different maturities. There are like from 1 day and far, far, far better than a fixed deposit, which comes with a fixed thing. At least that's what our comfort is. And like I said, if you want to make a choice for like 14 days fixed deposit, you can, obviously, but it just doesn't make sense. Even from a convenience perspective, that's far easier to kind of do this.
So there are some basic questions that.
So Neeraj,
yes.
Sorry,
yes,
I'm sorry to interrupt you. I will just run the poll, to see people's
Sure.
feedback. I'm just launching the poll. Can everyone see the poll question?
Yeah, kindly answer the polls.
Yeah, it will. Yeah.
All of you are here on Zoom can answer the poll.
Just keep it for another 10-15 seconds and
Yes,
I will
sure.
just end the poll. Yeah. Thank you, Neeraj.
So there are a lot of your clients already here.
Yeah, I can see that. That's why I started saying that we all are eagerly waiting and excited for this session.
So 26% still wants to fix a meeting with you. The link is given. People who are watching on YouTube, the link is there on the YouTube chat, also in the YouTube description. People watching on Facebook, if you want to fix a meeting with them, it's a free meeting, 30 minutes with no strings attached. You can fix it. It's there in the Facebook comment box. For people who are watching on Zoom, it's already there on the Zoom chat box. I think we can stop the.
I'll just stop
this,
I'll just do it. Thank you.
Okay. And we go on to the next questions, and maybe we can just have a rapid fire thing. What is the minimum amount we have to invest for a PMS, or if you want to join your Happiness Factory or mutual MFA is what you want. You want to become your client. What is the minimum amount we have to invest?
What's the minimum? So at MFA, I think the minimum amount, Meena, you got to correct me, but the minimum amount should be somewhere about 3 to 5 crores. That is the minimum amount. Whereas at Happiness Factory, there's no such minimum amount.
Okay. So even with few thousands, you can join Happiness Factory and start investing in mutual funds right away tomorrow morning or tonight. So Dr. Prasad is asking again, do you invest in bonds, shares, mutual funds and others, or only in mutual funds?
So this is an excellent question, Dr. Prasad, because one of the first thing that we always say is that our product is the financial planning process that we have. Our product is the client experience that we have. So the tools that we use today are mutual funds only, right? Because through mutual funds, you can get exposure to pretty much everything. You can invest in equity, you can invest in debt, you can invest in liquid, you can invest in gold, you can invest in pretty much everything through mutual funds because it's a tax advantage structure for you. Now, what do I mean by that? Just to give you an example of an equity mutual fund. Now, let's say you were to do an equity fund versus a PMS. When somebody buys and sells before 12 months in a PMS, you got to pay tax on it. Whereas if your fund manager buys and sells within 12 months, there's no tax that you pay, right? So it's essentially a tax advantage structure. So why are we saying mutual fund? Because the structure is, absolutely works to your advantage, as far as taxes are concerned, beyond the professional management, beyond the diversification, beyond everything else that's a part of it. So I would say that for our process, the most important thing is that the process is our product, or the financial planning experience that we have, that's our product. Otherwise, these are all tools. We predominantly focus on mutual fund as the basic tool that we use. And while we don't do PMSs, we don't do anything else. Yes, absolutely. If you have bonds in the portfolio, we can certainly guide you on it. But majority of our things is done through mutual funds. Now that's just a tool, I guess.
Amar, can I answer that? one more comment to that.
Yeah.
So it's not just financial decision making which MFA provides. They provide great service. For example, I had some bad insurance products, and we wanted to get rid of that. And typically, I did not have time to go to those insurance offices. So where it's very easy to buy insurance product, it's very easy to redeem it. Very difficult to redeem it. But actually, Mina did arrange for a runner for us to go to these places, accompany us, so that our task was done much faster. So it's a service. It's not just like a family physician. It becomes a financial family, and that is what I want to say. It's not just decision making or guiding as to what to invest, but it's a whole package of service which comes with that.
Thank you so much, Dr. Saral. Thanks a lot. Yeah. So actually, we help our clients understand which product makes sense for them, considering their situation, their goals. Just like how a doctor will recommend sorry, yeah, Dr. Saral.
No, it's also making a will. Things like very simple, making a will.
Yeah.
If my kids are abroad and you want to take care of their education, how to make them to invest. So it's a whole lot of things which comes. So they may say no strings attached. There are a lot of strings attached.
Okay, so the next question, the next question is a very interesting question. It's like, why not invest in direct mutual fund schemes after class consulting professionals?
Why not invest in direct mutual funds
basically,
after consulting?
So you consult with us, but basically we'll invest directly. It's something like,
so
let me just give an example as a surgeon first before you start speaking financially. It's like getting your surgery done from you, you're asking about the surgery and getting your surgery done by you yourself. It's like consulting Dr. Taral for surgery and then doing the surgery yourself. You can go ahead.
So I guess I don't need to answer that question. So I think I don't need to answer that question because you summed it up so well. You've answered it for me. I mean, I can't put it in any better words, but I'd just like to add. See, it's like a personal choice, right? Like I said earlier, that's not what I would do for myself. If I would go to a surgeon, I would go to him for everything. Right. But if you are coming to a financial professional, what do you value? Why are you even going to a financial professional? Because you can get a lot of dope. You can get a lot of stuff required on various websites. You can go to Google, you can check the top 10 funds, you can check the top 10 stocks that are doing well, etc. All of that. There's a whole lot of information on the web. You don't even need to waste your time going to a professional because all you can do is that top 10 funds to invest, top 10 stocks to invest and get everything. The whole reason that you're going to a financial professional is something else, right? And you need to understand the model that the financial professional is following, right? And then make a choice on your own. So there's that would be my response. But I love Dr. Neeraj's response to it. It's absolutely apt and bang on point.
Yeah. So just to add one more extra comment. So there are few doctors and very financially independent and they are very well read. And I know 2-3 of my friends who are there, who are very well read in our finance groups. They do a lot of trading, as I mentioned earlier. Those are a different breed. If you feel that you are like that, you should do it yourself. And if you like to have control, you should definitely do it yourself because you feel that you have studied so much that you can do it better. Then definitely you should do it yourself. Jokes apart. But supposing you don't have the time and inclination to do so much of reading and studying and then taking care of each and every small news item, small things, and you know how to interpret them, then I think you should give it to the professional and you should not play with your money. There is a high chance you'll lose more than you'll gain much.
Neeraj, when it comes to my own health, I am a doctor. I don't depend on my own judgment. So, I would really depend on somebody who knows that subject better. If I have hypertension, I will go to a cardiologist. Though I am a doctor, I don't treat myself.
Very well said.
And I'm sure similarly, when there are finance accountants, there are lawyers, there are people who are CEOs of companies who do depend on MFA or such companies for their financial, decision making, because we don't want to get stressed by that. So there is somebody may know in and out of share market, and I think still for your basic financial decision making and planning, it's better to have a planner than doing it yourself.
So there is one very important question. It's by Anonymous, and it is very important. I also used to feel first time an MFA came to me, and I think you should clear it out. A lot of doctors are reluctant in sharing complete information about their current finances. How important is this transparency? And can you actually help without us being fully transparent?
So I mean, I would again answer this question by taking an example of a doctor. It's like, if I go to a doctor and if the doctor asks me, right, you got to take a shot off, I got to diagnose you, and if I am going to tell him, no sir, I can't do that, and you got to tell me what the solution is. It just doesn't work that way. Right. So for us to do a great job at diagnosis, it's very important for us to have all the financial information in the first meeting itself. Right. And, not just in the first meeting, you can probably take a meeting or two, right, to be comfortable. But the point is that the meeting would be fruitful. The diagnosis would be fruitful if all the information is shared. And that's a part of the process. So the more thorough the diagnosis, the guidance can be that much accurate and tailor-made, right? So I think it's very, very, very important. And just like I said, you got to be comfortable with it, and that's a part of the process.
Okay, thank you.
I would just want to add one thing here, Dr. Neeraj. Just want to add one more thing here, saying that, one of the questions that was asked to me, during, I think the third question, Dr. Bhushan had asked is that, how do you choose a financial professional? So when you meet a financial professional in the first, I think 20 minutes, you can figure out, whether, somebody is worth getting data, somebody is worth doing that. But if you have to go through a proper, guidance and get a thorough diagnosis done, I think information, sharing is absolutely paramount. Yeah.
Fantastic. So there is an extension also. Specialist prescribes, chemist dispenses, CFP prescribes, a consulting physician prescribes. So you invest in direct mutual fund. But then you still have to go for follow-up to the doctor, right? So you have to go to the follow-up. So if you've done a surgery, or even if you're taking a blood pressure medicine, or you are a diabetic, if you're not following up regularly with the doctor, then the problem is going to happen that your sugar has suddenly shot up or gone down. You will not know. So the follow-up is important, that when to exit, as I asked, when to sell, rebalancing your portfolio. So all these things, as I told you, that if you have the capacity to study yourself, do study yourself. You don't need a professional, then you need websites like Value Research Online or whatever, Money Control, or wherever websites you want to go. That is my opinion. Amar, what is your opinion about this?
Well, I completely agree with you. Totally, with you, that the value of a professional, that the first thing that, you need to answer for yourself is that, why do you need a professional, right? What is the role that this professional is going to play in my life? I think that's the most important, question. And if you see that a professional is going to add solid value in your life, in your financial life, then you got to go to that professional. Otherwise, if you feel that you are equipped and just by looking at the next or the top 10 funds, you can plan your financial life around it. No, because like I've said, your investments are just a very tiny part of your overall financial life. Just to give you a context, in our lives, we all go through several transitions. Right? There is something called as almost about 60 to 65, financial transitions in most people's life. Right now, everyone might not go through those 60 to 65 financial transitions, but we are likely to go through some of them. So the birth of a child, divorce, death of someone, your loved ones in the family, your retirement, these are all transitions. Okay, windfall, succession planning. So every transition has got financial implications to it, right? And this has got nothing to do with investments. So one of the examples that I would like to give you here, and I'll take a few minutes. So one day about 7 years back, we got a call from one of our clients, saying that his best friend had behind two daughters. So one of the daughters was based out of Delhi, one was in the US, and the daughters didn't have any clue what the father had done. Now the father had done pretty much everything. He had done PMS, he had done stocks, he had done life insurance, post office, bank fixed deposit, and he had also lent money to a builder at the rate of 18%. Now, the moment the builder got to know that the guy is off, the payments kind of stopped coming. But the point was that these two children had no clue what the father had done. So our work started at that point of time, even to figure out what all the father had done. So we met the secretary of the deceased person, got an Excel sheet. We connected with pretty much everyone. It took us 11 months just to get the money on their names. 11 months. Getting and a whole lot of things. I mean, legal stuff, etc. All of that. So it took us 11 months. Now, in these 11 months, there was nothing about investing. Kahan paise dalu? So the whole thing was about getting money on their name. Now that's a huge value that a true financial professional will bring in your life, right? So there are there are a lot of transitions that we will all go through in our lives that have financial implications. So a real financial professional will help you with all of this. Investing, kahan funds dalu, ye dalu, wo dalu, that's just a tiny fraction. That is 0.1%. So if you want to focus on the 0.1%, that's fine. But a real financial professional can add a whole lot of value beyond this, right, on your financial life.
That's very good.
Yeah. So
yeah, very well said. So there is one question which is very common, and it is asked in all our groups. How do you choose which funds are good?
Sorry, how do you choose which funds are good? So for us, the most important, so we have a detailed, due del that we typically do. That detailed due del is very, very, very extensive in terms of it's almost about, I would say about 12 to 20 pages of data that we typically gather, and we gather that at a fund house level. So everything starts first from a top down approach, not the bottom up, that which fund is doing well. And then, so we look, so a whole lot of, parameters. Like I said, I would do a couple of hours, session just to talk about this question, because it can get extremely technical, it can get extremely detailed. But one of the things that I would say is that look at the pedigree of the fund house, look at the consistency of performance that they have, because consistency of performance is extremely important over a one-off performance that someone could probably deliver in a year or two, right? So what's the consistency of performance? What are the risk management practices? What are the risk management principles that this fund house follows, right? It's very, 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 very critical. And this is something that is missed out by most people, right? People just look at one parameter. Boss, performance kya hai? Okay, performance 100%. This must be a good fund. No. Okay, so what's the risk that this fund has taken to deliver that performance, right? So what's the risk that has been taken to deliver that performance? It's absolutely critical. So beyond that, there are a whole lot of risk management, parameters that we take, stock of. We look at the risk management team beyond the fund management team, and look at consistency of performance. And like I said, there are a lot of technical parameters that we look at when we make these choices.
Okay, that's very good. So there is one or two more last questions. If the anonymous attendee, if the market will always go up, why do we need a portfolio manager?
Great. So the portfolio manager is not to manage the market. The portfolio manager is to manage you, right? So the portfolio manager is like, obviously you're required. I mean, I'm not saying portfolio manager, that's a wrong word, but a financial coach or a financial planner is there to help you. He's like a slide that Meena had shown. Yeah, okay, the financial, about a Sherpa, guiding someone to climb the mountain, because again, financial planning process, okay, is a skill, right? And there's a whole lot of stuff, because your financial life extends over a period of 30, 40, 50 years. And we know that there are a lot of biases that each one of us have. We all know that buy low and sell high. But world over, right? Everywhere, around the world, what do? Right? We sell low and we buy high. Now, what did a lot of people do last year? I mean, a lot of smart people that I know, a lot of smart people, they'll go on events, they'll talk big things. But what did some of them do in March 2020 when the markets went down? They sold. Now, are they going to admit that they were out of the market, right, for an extended period of time? Now, the market is going to do its own thing. But the point is that, what are you doing, right? So you need a real financial professional to handhold you through such tough times, to emotionally guide you, to emotionally counsel you. And because that's a big value add that, real professionals add, right? So how do you, because, if your financial professional didn't let you exit, okay, last year, he's already justified his value by, I don't know number, but several times, at least for the next 20, 25 years, he has justified that value because you didn't exit at a certain point of time. And I know of several smart people who exited at 36. They are still out of the market, waiting for a correction. And the market has gone more than 50% from that level. So that's why you need someone to be on your side. You need someone to handhold you, coach you, guide you, so that you can take prudent decisions, so that you can take wise decisions.
So one very important question is that comes to my mind also sometimes. Dr. Shrikant Dalal is asking on YouTube, can you please suggest how to learn asset allocation? How do you know that your financial advisor or your financial coach whom you have appointed is doing the right asset allocation for you?
He's doing the right asset allocation for you. Now that's a part of the conversation, right? Yeah, that is a function of your financial goals. Now, let's say your financial goals, you require only 3% or a 4% return, okay, to be met. Then everything can be in just liquid funds. You can have a portfolio of 100% on liquid funds. But are you going to do that? No, right? Nobody is going to do that. But if you have sufficient money or you're purely from debt, yes, you can have 100% debt portfolio. Now, so like I said, it's a tailor-made suit. It's like a tailor-made plan for you. Every financial plan is like custom made. Every financial plan is different, because every family has different sets of goals happening at different points of time. Right, their cash flows are different, their assets are different, so everything is customized and then tailor-made. So the way to ensure that you have the right asset allocation in place is to have conversations with your financial professional. The way he or she explains it to you, right? The rationale behind asset allocation for a particular goal, right? Every goal will have its asset allocation, and then there is a strategic asset allocation, which is a combination of all the goals, right? So let's say each goal will have its own sub asset allocation, and then overall you add all of these and you have one asset allocation. There is no right or wrong asset allocation, but what's critical is that it's a function of when do you need money, what is your ability to take risk, what is your behavior towards risk. So a whole of parameters which got to come in place. So your financial professional, have a good conversation with him, understand whether this is the best for you, right? So it's absolutely custom made. and you got to have a conversation and then figure out.
Can I add to this, Amar? Can I add to this?
Yeah.
Yeah. So basically, I think, Neeraj, the first step is choose the right financial coach. And the second is trust him 100%. If I go to a doctor and if I try to understand what instruments he's using, how is he doing the surgery, telling him to give me a view of the surgery, then if the trust is not there, I think nothing works. So the first step is choose the right professional. Spend a lot of time choosing the right person in your life who can manage your money. And I think once that is done, just trust that person. Otherwise, it doesn't work at all. So when I've gone to a doctor and I have not trusted the doctor, things have never worked for me. And wherever I have trusted the doctor, things have always worked for me. I think this is the law of life, and it applies everywhere else. Yeah. So that's what I thought. I'll just add to it.
Well said.
Yes, I think that's, yeah. So that was a very good session. That's all for tonight. And we have answered all the questions which were possible to answer, and we have completely utilized Mr. Amar Pandit for our benefit. And for those who have missed it a little bit, you can always go and see it on YouTube. It's available on Ortho TV YouTube. You can subscribe to it. You can message me. And of course, there is a meeting link also in the YouTube description and the Facebook comment box. And also here it was sent in the Zoom comment box. If you want to fix up a meeting with them, you're most welcome. And for those who have not joined our Dr. Finance groups, do join our Dr. Finance groups as the time goes on. So we thank you, everyone. And good night and good morning to you.
Yeah, thanks a lot.
Have a nice day.
Yeah, thank you so much.
Thank you so much.
Thanks a lot.
Thank you so much, Dr.
Yeah.
Dr. Bhushan, Dr. Mandar, Dr. Taral, everyone. Thank you so much. And thank you, audience. Thank you, Meena.
Thanks a lot, Amar. Thank you so much.
Had fun. Thank you.
Yes, thoroughly enjoyed it.